Good day. I'm Martin Gagel with Market Radius Research. It's Tuesday, October the 4th, 2022. We've got CEO Bill Di Nardo of Pivotree joining us. Pivotree designs, builds, and manages digital commerce, data management, and supply systems globally. It's great to have Pivotree join us. It's a substantial software and services company running at over 100 million of revenues. They have an interesting strategy designed to grow profitability as a company converts projects and client tools into recurring software solutions or SaaS solutions to drive a steady, growing, high-margin revenue base. With over 250 global clients, 100 million of revenue run rate, growing at over 70% year-to-date with acquisitions, while trading at less than 1x revenues and much cheaper than many of its peer groups. I'm trying to figure out whether the current valuation and opportunity creates good value for investors right now. But please remember, this is neither a recommendation nor investment advice. We're here to learn about the company. So with that, Bill, CEO of Pivotree, thank you very much for joining us, and tell us about Pivotree.
Martin, thanks so much for having me. And I hope by the end of this, we'll be able to answer that question definitively for your investors out there. And I'll do my best to lay the foundations for that conversation. And as you said, if you've got questions along the way, don't be shy about interrupting me, and we can go a little deeper in certain areas. I'm a big fan, where they say pictures worth 1,000 words, full motion video these days is worth even more. So if you don't mind, I'd like to just play a little intro video to give you a flavor of what Pivotree is about.
Sounds good.
As a leader in frictionless commerce, Pivotree designs, builds, and manages digital platforms for commerce, data management, and supply chain for over 250 major retail, branded manufacturers, and distributors globally. Our digital solutions, along with managed and professional services, provide enterprise customers with a frictionless end-to-end formula to support and manage complex digital commerce platforms. We believe we're living in an age where every buyer expects consistent experiences that meet their own personal expectations. Pivotree is investing in and accelerating this new era of frictionless commerce with digital solutions that help companies apply this thinking holistically throughout their entire value chain.
Well, let's dig into the business a bit. You're going to hear that word frictionless commerce a lot, and I hope to be able to give a little bit more clarity around what we're up to and why we're different than something else you might find out there in the world of digital transformation. There's the usual disclaimers, which you'll find in this presentation. You can download this from our website. I think it's really important to start with, we are a business that is on a mission. And the mission really started with this vision of the future that we imagine. We've all been customers through the pandemic. We've all been customers that are buying, whether it's, again, in a B2B or a B2C sense. We all know what friction looks like, how frustrating it can be, how challenging it is. We all want to live in a world where our commercial transactions are truly frictionless. Our job is to help make that vision a reality. Now, we think we've been on a march as an economy for 20 plus years. The latest big change that occurred in the mid-90s was the advent of the internet, commercial internet. I mean, obviously, we know that's been around for a while. The commercial internet brought us e-commerce, and that was one of the first big changes enabled by this networking technology. It's been accelerating since then. And what we're really seeing now is the next generation, the next evolution towards this state of frictionless. And our mission is to help our favorite brands make that transition, moving closer and closer to that ideal kind of transaction. There's 4 things we need to do to win in this space. And this is what you can see in all of our behaviors and our acquisitions. They're really in aid of these 4 key drivers that will lead to our long-term success. We need to achieve scale in key commerce growth categories. And one of the things you're going to hear from me today about is there are really 4 different categories, 3, in fact, that we're hyper-focused on. But those key categories are more than just the shopping cart. It's more than just the UI experience. We break it up into search, find, buy, and get. And that really is what Martin described earlier. It's commerce and user experience. It's the supply chain from product ideation through to delivery of it. But it's the data that runs underneath it. And frankly, data is the driver ultimately of frictionless transactions. We need to be at scale in all 3 of those. And so you saw us do some acquisitions last year to help accelerate that. But step 1 for us was play in a material way in each of the key categories. We then need to bring the enabling technologies, just like the internet transformed commercial transactions and introduced the new generation of e-commerce. There are other enabling technologies, Internet of Things, machine learning, augmented reality, the cloud transformation. All these things are accelerating us towards a state of frictionless. But our customers have a challenge at times keeping up with the pace of change. And that's where our third important driver of long-term success is building products and services that make it easier for our favorite brands to be able to adopt these new capabilities. So again, be in the key categories, leverage the enabling technologies, productize them as much as possible, and ultimately integrate them. If you lived through the pandemic like we have recently, and you had to buy stuff, it was easy putting them into a digital cart. You didn't always know you were going to get it, when you were going to get it, if it would arrive when you needed it, because the supply chain was not as strong as it needed to be. And that's why you have to think about this as an integrated, connected set of categories. You can't fix one and not fix the other. And that's why we play in all three of those categories in order to drive frictionless forward. Now, we are a very real business today. As Martin pointed out, we're run rating over $100 million in revenue. It's really important to note that we do provide almost $10 billion of gross merchant value runs through the systems we manage for our clients. And already 40% of our revenue is recurring. Our history really was managed services. We've been adding professional services over the last couple of years to round out our skills and abilities. And we have a really strong balance sheet. And the reason we have a strong balance sheet was we felt like we were going to be on an acquisition trail. And so we IPO'd a couple of years ago. We maintained our discipline in the way we allocate capital, and we still have a healthy balance sheet with cash, no debt on it currently. We've got access to an undrawn line, and that really is for more acquisitions, which we think this market is going to allow us to deploy capital very effectively. We won't touch the line of credit until we're fully profitable, and that is coming in very short order. So we expect to be able to start tapping into that line in the new year. That's a self-imposed requirement, Martin. We don't have any requirements from the bank that we have to be serving any EBITDA covenants, but philosophically, we don't want to service debt with debt. So until we can pay for the debt with our own free cash flow, we won't draw on it, but we expect to be able to draw on it in 2023.
And obviously, if you're profitable and you only want to draw on it when you're profitable, the only use for that then is acquisitions.
Correct. And we have a very healthy pipeline of acquisitions. First, we'll prioritize using our own cash to do that. Really third on the list, frankly, is using our equity. Now, given our current equity levels, a number of the people we're talking to would love to take our stock as they see upside in it, but really we don't want to give away stock at $3.50 a share. So number one will be our own cash. Number two will be the line of credit. And when our stock price starts to come back up, we'll start to use that in our transactions again as well. The other piece I just want to point out here, because it may be lost on some folks when we think about only 250 customers. You're going to see it shortly with some of the data. The reality is the largest concentration of commercial transactions happens in the top 1,000 retailers and branded manufacturers. So the who's who of retail is who you're really after. They represent the greatest volume of transactions, and we work with big customers. So we're not an SMB focused. If you look at our gross merchant value per customer, it's significant. There's some other folks out there that will talk about, $50 or $100 billion of transactions that go through their systems, but they have 1 million clients that do that. We do 10 billion on, and frankly, our top 100 are probably the most significant contributors to that. So we really are focused on the larger end of the retail and B2B distributors and manufacturers. That's the scale we play in. And really, we're helping empower that group to achieve this state of frictionless, to help their buying journey for their customers improve, make it easier to find what folks are looking for, get it in a cart and get it to them, and all the while building trust. I mean, trust is a key element for frictionless. The amount of information you need to share in order to get to the state of frictionless demands trust be built into the system. So we design, we build, and we actually run these systems for customers.
Bill,
Yeah.
The software industry is great on buzzwords and so forth. When you say frictionless, what do you mean by that? It's a little cloudy, a little fuzzy.
Yeah, and there's some great stories that you can look at out there around examples of frictionless. I'll give you a very simple example of a transformation in a particular industry that really highlights frictionless. You remember pulling into parking spots and dropping quarters in, to feed the meter, and then going to your meeting and realizing you were running out of time and you were going to get a ticket and racing back out and firing quarters in. Well, today you can pull up to that same parking spot. If you've got the app on your phone, you can put just enough money in for however long you think the meeting will be. You get alerted if you're running out of time, wherever you happen to be sitting, you can add more time to it. Well, the next stage of frictionless for that would be there is no alert. As long as the car is sitting in the spot, your car is connected to that location, knows you haven't moved, knows you're running out of time, and the wallet automatically updates your parking. That would be a demonstration of the evolution of frictionless in a simple example of parking spots. Other examples would be, going into the store and realizing that what you were looking for, they don't have in your size and your color and your choice. Frictionless would allow you to know where you could go to pick it up, know that they have it in your size, put it on hold. And again, you would think that that's available today. It's still not as common as we might imagine. The technologies are available to be able to do that level of frictionless right now. And that's where we help our customers improve that experience.
Bill, when starting this, I just assumed everything sort of Amazon and e-commerce, but you give the example of walking into a store. So your solutions, and I think any successful retailer now is sort of the omni-channel thing. Like your online inventory has to be matched with your bricks and mortar inventory. So you're not just hooking into Amazon and to Shopify or e-commerce platform. They have to be integrated to the store level data and inventory management?
Absolutely. Yeah, so our supply chain does a lot of work in order management systems, and order management systems are really about identifying where the inventory is, the best place to ship from. It's turning every store and physical location into a warehouse in some respects. We've done some really interesting projects for some B2B clients who have now started to identify inventory parts that sit in a customer's warehouse that aren't being used and being able to make that inventory available in a pinch. Again, you think about reducing friction, why go build a replacement part that might take weeks to fill that order if you can find it exists in the ecosystem and ship it to a customer the next day? This is about creating visibility in the entire ecosystem for where product sits, most efficient place to ship from. And ideally in the long run, Martin, where we see this stuff really changing, when you get into 3D printing, when you place your order and only then produce a product and be able to ship it from the closest location. This is what we expect to see continuing over the next decade towards truly frictionless.
All right. And since we're sort of in real life kind of examples, they're not just online, that parking example, do you work in IoT type of stuff? Is that potentially integrated into your stuff as well?
Absolutely. Absolutely. Okay. A lot of our customers are integrating web apps into their mobile devices and again, you can see folks, and I won't name names, but you can see examples where a Peloton is really now a place to be able to perform transactions right on the bike you're working out on. You will imagine, again, in contextual environments where you're performing something, maybe you're working out or doing something, you're seeing the things that you need and want, and you're able to buy them there. And that will come from that internet enablement of devices. Things like 5G are really, truly turning the internet into a ubiquitous, fully accessible all the time. It's inevitable. When we think about Omni, I mean, it really, truly is, with the advent of this acceleration in our networking capabilities, the internet will be always on everywhere you go.
And I guess just the extension of that, you see a shirt on TikTok or Instagram or whatever, you click buy here and boom, you don't have to pull out your credit card and put things in and find out it's not in stock and all that.
One-click purchase, right? That's part of that frictionless state. And part of what you're describing, Martin, that's available technology today. Those are things you can do now. Not everybody's got it enabled. And again, one of the biggest challenges we're finding our customers telling us is that part of the search and find is actually the easy part. Increasingly, that user experience now, a lot of folks have advanced systems, getting that product to you, the customer, profitably is where our partners struggle a bit more. And that's where they need help around their supply chain. And how do you make that one-click purchase cost effective and beneficial for everyone, including the vendor?
All right.
So that's why we actually really look at this strategically as three categories that today are commerce, data, and supply chain. And the commerce part is, again, the search and the find. It's that digital cart. The supply chain is all about that order management, warehouse management, how the stuff moves through your logistics systems. The data management runs underneath all of it. So the way we work, and I know sometimes people need a couple of minutes to really process this, but we start with professional services. And usually on one of those technologies you see at the bottom of the screen, well-known enterprise level applications that solve some very specific problems. We help our customers identify the problem they're solving, work with those partners, stand up that technology and implement it for them. That's the design build part. But we often add an overlay of managed services. If you came to us because you didn't have the skills to do the work yourself, you probably don't have all the skills you need to manage it and maintain it. And this is where we bring our managed services in, hosting, all the automation tools that we have, securing it. So each one of these categories has a implementation, an advisory type capability that design build. And each one of them also leverages our managed services stack, which allows us to run that for our customers after it goes live. We started our business more than a decade ago, mostly in managed services. We felt in order to do better for our customers, we needed deeper understanding of their applications. So that's why we started acquiring those PS skills, professional service skills, so we could go deeper into the applications and really support our customer beyond the infrastructure. So that's the way we think about our business today. 3 different categories. Each one of them, we're trying to get to a certain scale. Each one of them we'd like to see generating 100 million in revenue. And the managed service is really binding them together as that connective tissue.
And I guess just as your clients are big clients out there, and they don't have they're not just some small business with a Shopify and Amazon account. They've got SAP and all sorts of integrated, dispersed. You can't just like an API, plug it in and boom, you're off to the races. You really have to, they've customized their stuff. So then you've got to kind of customize it to fit how they've sort of tweaked their systems in the back. So that's the need for the professional services. It's not just linking something to my Google Docs.
You know, that's a great insight, Martin. I think you might know your way around this business. That's the challenge for large retailers and large manufacturers. They've been doing this for 20 years. They've built all kinds of systems to get them to this point, and they can't just throw them out tomorrow. They've built entire processes around those systems. But our goal is eventually for them to be able to make it simple API connections. In fact, some of the products we've gotten here, you can see Pivotree Connect. It is purpose-built API orientation for commercial transaction-oriented clients. And the idea is we've got to stop recreating this technical debt for this marketplace, right? They spend a fortune replacing previous systems when it should be more evolutionary. So what we talk about when we talk about this move towards productization, we have 2 different types of products to make that transformation a little easier. Assembled products. This is when we take readily available technologies in the market today, and rather than try to build them ourselves, we connect them. We build product bundles out of them. Think about it almost like a mutual fund. We have experts that know which products go together. We assemble them. They interact and they have a role based on risk profile. And we do all of that for a customer to deliver them an outcome. Rather than have the customer go and select different technologies, we assemble them. We deliver it as an assembled product. That's the vast majority of our recurring revenue today fits in this assembled product category. But when you have deep professional service skills, you know the applications, and you're getting good insights into where the customer's problems are, you also start to find gaps in the available technologies in the market, and you start to build your own. And that's our engineered products. We use machine learning in very specialty applied areas of our data management business. We take algorithms that are available, but we write our own code around it, create the wrapper that allows us to implement in a data management problem. And we're able to now use our code to help make that transformation faster, more efficient. These are our engineered products. This is our IP. Now, they're both our IP, but you won't find these solutions in engineered products in the market. Whereas our assembled products, we're gluing together and we're packaging up products based on readily available parts. 2 very different approaches to the market, but the outcome is the same. We really try to sell solutions and outcomes to our customer rather than sell them technology.
All right.
We've talked a bit about this already, but the size of the market is massive, and the transformation it's going through is consistent over 20 years, and it just keeps going. The B2C marketplace alone is about 4 trillion in North America, and the B2B is about 17 trillion. And when you look at the size of these markets and more the assistance of the digital part of it, we don't even think about it as e-commerce or brick and mortar. It's digital assisted. And our belief really is over the next 10 years, that line's going to be blurred. We're going to stop talking about how much is e-commerce, how much is in store. 100% of all transactions will be digitally assisted wherever they're happening. That is a reality. And that's really what all of our customers are spending towards. The level of digital assistance that drives the reduction in friction, that drives a better customer experience. This has got huge tailwinds that are not going to slow down.
Well, I was just, it was in Best Buy a couple weeks ago, and they've got digital price tags now, and I've seen that in a few grocery stores too. I was just thinking, like, the complexity to make sure that you've got that right and that you've got the right price across the whole system. And at least if some guy with a marker wrote down the wrong price, it's one thing, one location. But to have that all tied in, it just seemed kind of sophisticated and complex.
Think about 35,000 SKUs in your average grocery retailer. I don't know the latest on an electronics store like Best Buy, but it's substantial. Think about the number of geographies and the number of pricing zones they have. This is where it's too much for one human being to manage those things. And that's why, product information management, the catalog, the pricing models, increasingly they're becoming more and more automated and digitally assisted. So this, again, is an example where you can reduce friction for our customers on how they can dynamically generate price based on conditions in the market. And they wouldn't be able to do that 10 years ago, to your point. It was going to be someone with a marker walking down the aisles trying to fix things. That's the world we're in today. It's a great example, Martin. Thanks.
All right.
The reason we think we're so uniquely positioned is if you look at our competitive set, it's difficult to point to a single competitor. In each of our different buckets, you'll find, as an example, global digital consultancies. We find ourselves competing sometimes against Accenture and IBM and Deloitte, systems integrators, like HCL and Infosys, a lot of the India operations. There's digital agencies. A lot of them are more boutique, and they tend to be more straightforward, front-end experience oriented. But we're very unique in the way we connect the front to the back. We're very unique in the way that we're investing in the products to make those connections. We really don't rely exclusively on a project relationship with customer. It's a management and outcome-oriented relationship. And again, we play in the 4 categories together, where you'll find most of these groups tend to be much more focused in a vertical rather than a set of capabilities. And I think that's one of the reasons why increasingly we're starting to win against these competitors, because we have the breadth and the depth in a very narrow set of transaction-related applications. And I think that's really showing in our results. We've had a consistent 4-quarter growth, organic, as well as the benefits of some of those acquisitions you described. Really, when we do acquisitions, we're looking for revenue synergies, not cost takeout. I'll talk to you in a minute about our profitability path, but we really have been looking to build capabilities that are meaningful to our customer, and that's really showing in our bookings. We had record bookings in Q1 that led to record revenue in Q2. Q2's bookings are a little misleading. My CFO, God bless him, is honest as the day is long, and we had $1.6 million come in the next day after our quarter close, and we didn't include it. But the reality was we're pacing at about $15 to $60 million of bookings a quarter. That's our average. 19 was a real exception. We see a lot of momentum continuing to build. Our pipeline is very healthy. We've seen no slowdown as a result of some of the doomsday sayers out there of recession and inflation. Our customers are continuing to come to us. And I think part of it is because what we do for them helps drive revenue and reduce cost. So those are 2 things in any sort of recession or an inflationary market you want. And again, the revenue results speak for themselves. So consistent growth, we got a good bookings to billing ratio, and you can see our recurring revenue has been pretty stable over time. And that really also helps manage predictability on coming quarters when you've got that long-term visibility to where 40 to 50% of your revenues are coming from.
Sorry, can we go back that slide there? on the right side with total revenues, the last 4 quarters have been quite the ramp up. Is that, I don't remember the exact numbers, but you've got organic and acquisition growth built into that. The recurring has been kind of steady. It hasn't been growing at the same level. Could you talk about kind of what drove the growth? And is some of that non-recurring, then once you sort of finish a project, does that get converted into recurring revenue thereafter? And I just threw a lot at you, so I'll stop.
Yes. So there's a combination of factors. We obviously benefited greatly from our acquisitions. So the acquisitions of Codified and Bridge, but they got us into categories that mattered. What was phenomenal was post-acquisition, their growth trajectory continued. We were starting to bring them into our other customers, their customers. We were being brought in with some of our other capabilities. So the first thing you start to see is cross-category selling goes on. And yes, when you stand up and complete projects, you then have the opportunity to win the recurring business. And so we did make some announcements recently where some of the project work we had done had started to convert into that monthly recurring revenue. Really, part of what you're seeing here and the reason that the recurring isn't growing faster in absolute, so we've got some headwinds as well. We have an older part of our business that's mature. If you read my CEO letters, I'm very open in discussing it, but it's the Oracle ATG platform. It's going away. I mean, we've known that for years. It's a slow wind down. It's a very big, complex environment, and customers move on to other platforms we've got available. But that is a big chunk of our recurring revenue. And that has been slowly winding down over an extended period and will continue for another few years. Those declines offset what are otherwise some good growth numbers inside our recurring business. And that's why, it's modest growth to flat is what you're seeing here. And that is mostly because what goes on underneath the number, some offsets. We think once we work out the bulk of the Oracle business, you'll start to see the recurring revenue climb again in double digits.
You do a lot of professional services. Is a lot of your business of that non-recurring sort of like you send a consultant out for so many days and you bill by the days, or is it more or do you where is sort of the labor versus the tools, or do you divide that stuff up? Can you sort of dig into that a bit?
Yeah. So professional services, again, it's really important to note we don't look like the traveling salesman who goes out for a couple of weeks and creates a bill and then off we go to the next one. We have long-term relationships. We tend to be more like retainer is the way to think about it, Martin. We've got customers that we've been doing professional services work for many, many years. So we shift from one project to the next, or we might be on a 3-year implementation, where we've got a series of sprints where we're adding new features and capabilities. Some of our customers, we do the exclusive work on constantly updating their store, their digital store. So the nature of our relationships is a big portion of our non-recurring. It's reoccurring. It doesn't qualify as MRR in our minds, but it also isn't what we would simplify down to project-based revenue. It is exactly like you described, professional services. So we do charge an hourly rate for the work that we do for them. But increasingly now we're finding customers that want to buy outcomes from us. And so rather than sell a labor rate, we will sell a business outcome. And we're able to improve our margins that way. So our margins on the PS side have been anywhere between 42 and 45%. And the margins on the managed service side are closer to 50. Managed services has less people involved, more systems. Well, we run it on AWS. We have a lot of automation and what we call DevOps, where we codify the systems, our security measures and our alerting and our telemetry. Those are all the things we are selling to our customer. So most of the COGS in that group would be our data centers, software licenses, those kind of things. All the COGS really in professional services are labor hours.
Gotcha. When you build a tool, build some code for a client under, you do that under a contract, you kind of sell that to them once, and then once you've built that, then it's, I guess, just easier to deploy to the next group who asks for the same thing, or does that automatically turn into a bit of a SaaS, or do you you got to be there to maintain it, like 10%, like in the old school days, you sell $1 million of software, you'd have $100,000 a year of sort of support services to keep it up. Is it something similar to that?
So again, remember, most of the implementations we're doing are somebody else's software, like SAP or like VTEX. And so we are configuring, sometimes we're coding, we're writing the certainly the integration points in a lot of cases. We can build accelerators, reusable code library. And our goal for our customers, frankly, is to leverage those because it means we can get it done faster and we can probably be more cost effective than if everything's customized. So over time, the goal really is to have that library of solutions that are pre-built. We are building accelerators in all the core platforms that we offer. And again, the goal is don't customize what doesn't differentiate you. Right? You don't need to customize every aspect of that experience. You need to customize the things that are truly unique to you as that branded manufacturer retailer. And our goal really is to lower the commodity components so you can focus more of your dollars on your differentiators. So yeah, we do have reusable IP in a lot of what we do. And that would be like our code library. Different than our SaaS products. When we build generally now a microservices architecture, very modular, very API oriented. When we build those, we build them as if they are going to be a standalone product. And so sometimes a customer will want that. We might do a joint development together, but we start right out of the gate with that one as a packaged piece of software that we're building.
All right.
So again, one of the things that differentiates us is we've got great margins, really, really high gross margins, whether you compare us on PS or managed services. And where that leads to is EBITDA. We were EBITDA positive before we went public. We reinvested a lot of the money we raised into accelerated growth. And you can see in the first half of 2022, we started to get back into the positive zone on EBITDA. We made a commitment to the capital markets that we would be positive EBITDA, predictable, consistent, by Q4, and that's still our plan to exit this year with strong evidence. Everyone will see that this is a clear path to profitability. And the reason we're doing that is we want to be in control of our destiny. We've got big, ambitious plans. They're stretching over 10, 15 years. This is not about one quarter to the next. This is very much being able to stay on our path. And the way to do that is produce cash and be able to control your destiny. So we're, you'll start to see some of those results show up in the next 2 quarters. As to what we mean.
Bill, just to clarify, make sure people's expectations are right. Are you expecting Q4 to be EBITDA positive or kind of January 31st or December 31st to be EBITDA positive? So this Q1 23 will be your first positive EBITDA quarter.
No, it's a good question, Martin. So you can see from this, our adjusted EBITDA for the first half of the year is in fact positive. But we did, again, if you go back to the CEO letter that I write, I try to give a little bit more transparency and detail to what's going on. We said, don't think about Q2 as an EBITDA positive quarter, even though it was pretty close. There were some one-time benefits we got in there. So when we think about and talk about, that communication of EBITDA positive, we're talking about the predictable, the consistent. We could still very well end up having the whole year be EBITDA positive if a few things break our way. But we wouldn't call that, that predictable outcome. By Q4, we expect Q4 will be EBITDA positive, and we expect that number will be repeated thereafter. That's the difference between where we are now, which is, very close to consistently, predictably being EBITDA positive. So yes, Q4 will be positive.
So on your path to becoming EBITDA positive, did you say, okay, the markets are very different than they were a year ago. We're going to do some cost cutting, or did you kind of grow into that, or kind of can you like you seem pretty confident? Well, we're in Q4 right now. What was the path to becoming EBITDA positive? What levers or dials did you have to adjust to get there?
Yeah, it's a great question. A couple of simple things. One, maintain margins and continue growing. Obviously, that starts to flow through to the bottom line. 2, we had structured our business into business units. Each of those business units has now been operating independently for 9 months. Each one of them produces positive EBITDA. We've been reinvesting that into products and other corporate services to drive accelerated scale. We've figured out what's working, what's not. And now we've started to pare back in areas that we think are not producing the kind of results that we would deem a great ROI. And we'll reinvest some of those dollars. But the short, simple answer is the engines of our growth and profitability are going to continue to get supported, and they continue to be very, very profitable. And we're going to spend less in the corporate group. That's the single biggest change, and that's why we've got so much confidence. Is we know how to manage that dynamic. We've been investing for quite some time, and now we're starting to look at which investments have been paying off, and that's where we're starting to make some changes.
Looking forward, you're still obviously a growth company. Are you trying to grow your EBITDA, or are you just like, once you're kind of EBITDA positive-ish, you're not dependent on like external financing sources? Does everything get thrown back into growth, or are you trying to balance? I presume you're not like looking to pay a dividend anytime soon. You're still on the growth pedal. Like, how are you managing cash flows with growth in terms of reinvestment?
Yeah, first and foremost, Martin, our belief is to control our destiny. You have to rely only on yourself. So we need to produce cash ourselves. That's the goal now. And with that, it opens up access to lines of credit. We can continue to acquire. We're only looking to acquire generally EBITDA positive businesses as well. So again, that should be very accretive. So this is really about control destiny and reinvest, to your point. We don't need to be wildly profitable today. We need to be profitable enough to control our destiny. Our goal is to reinvest, but with discipline, just like we've been very disciplined about how we bought companies, the valuations we give, the level of diligence. We took a lot longer than people wanted us to buy the first two. And in the heady market where everybody was saying, spend your money quickly, we were punished for doing that. Today, people look back and see what our natural behaviors are. We're pretty thorough. That will continue, and it will extend beyond just acquisitions to any investments we make inside the business. If the long-term value of a customer on a product is big enough relative to its acquisition cost, we'll invest more into it. But our new threshold now is positive cash flow, regardless of level of investment.
All right.
And I touched on it a bit, but if you take a look at when we bought these two businesses in 2021, it was still quite a heady market. We negotiated great deals, good for the entrepreneurs, but very good for the company. All of them single-digit revenue multiples, all of them single-digit EBITDA multiples. And these were businesses that were growing with positive EBITDA. We're very disciplined allocators of capital, and that's going to continue. We have more acquisitions lined up. We're still waiting for the private markets to sort of catch up to the re-ratings that have gone on in the publics. But we're seeing light at the end of that tunnel, with a number of deals now looking like they're starting to close the gap between what we're willing to pay and what the entrepreneur is willing to take. So again, expect to see more of this from us, but we'll continue to be patient. We will never predict which quarter something will close in, because they tend to have a life of their own. But we expect we'll get more deals done, especially in the way this market is evolving.
Could you, on the acquisition side, discuss what would sort of an ideal or typical acquisition be like in terms of size? Are they kind of tuck in? Are they like, is there a lot of indigestion, sort of put them together? Are you looking to do a big transformational one?
No.
And that could just discuss those parameters.
Nothing transformational right now. I would say that, hey, look, all of these transform us, right? You start to inject new DNA. They help with your growth trajectory. You're able to do more for your customers. So I would say every deal we've done has in some way transformed us. Transformational, not in the sense of we're going to tack on $200 million of revenue in one go. These tend to be 5 to 15 million in revenue. They tend to be anywhere between 15 and 30% EBITDA. And we're looking generally between, 0.75 to 1.5 times revenue, but more importantly, a single multiple of EBITDA. That's generally what we look for. We used to use rollover equity as part of it. We generally don't do that right now, given our current stock price. So we rely on cash, earnouts, and as our stock price comes back, we will likely start using our stock as part of that currency, but not right now.
And when you integrate the companies, I think you mentioned previously, you're kind of integrating for growth. It's not like you're just trying to cost cut the company and sort of bleed it, whatever cash you're buying it for it to become another growth pillar.
Yes, it's always part of our strategy. There's 4 or 5 things we look for when we qualify deals and put them into our pipeline. Obviously, revenue growth as evidence that what they're doing, customers need. It fits into one of our strategic requirements, brings a depth of skill or capability that we're looking for and that our customers need. Today, it needs to be EBITDA positive. We might have squinted, a year or two ago. Now we're very focused on not burning cash. And ideally, it has a path to recurring. So every deal we've done so far has brought with it some form of product, IP, or recurring revenue. We want all of those characteristics. It's not one or two or three of the above. Every single characteristic needs to tick the box before we would really seriously consider the acquisition.
And the sellers of that are they entrepreneurs or guys who've been doing this a long time and just, I don't know, want an exit, or are they joining the pivotal team, or talk about the vendors, their kind of rationale?
Yes, they're almost always entrepreneurs. In fact, I don't think we've ever done, like a venture backed, not the management team that built it is selling it. It's generally the entrepreneur. They bring deep domain expertise. They know something exceptionally well and have been at it usually 5 to 10 years at a minimum. And so we see entrepreneurs that are looking for a good home, looking for the next phase of growth, or see how they would plug into something really meaningful and material. So there's been a number of deals we're active in right now where they are entertaining other offers, but they like the strategic fit with us, the opportunity to come and be part of this team. We're 600-700 people, we're 100 million in revenue. There's still a great opportunity to leave an imprint, right? To really leave a mark in the industry. And we have the kind of balance sheet and the capability and the management team to help ambitious entrepreneurs go even further. And I think that's who we're really interested in.
All right.
We really did build this for the long term, Martin. We are ambitious about where we're trying to get to and surrounding ourselves with the best people possible. So a number of my executive team, again, have been there before, have been involved in $500 million, $1 billion revenue businesses. We've strengthened the team this year with the addition of Todd and Edgar, really, really excellent operators. And then our board of directors is very diverse, lots of different backgrounds, which makes for spirited discussions in the boardroom. All of them, again, ambitious about our goal towards frictionless. But we have, folks like Bill Morris, who ran Accenture Canada for many years, a great operator, and for me, a great person to sound ideas off of from an operational perspective. Obviously, coming out of Accenture, knows tech well. Brian Beattie. He's the CFO of Valaris, which is the largest Constellation business unit. He's really helped guide and shape our M&A methodologies and processes. And Ashley is voice of customer. She's been the CTO, CIO, COO for some of the biggest retailers in the US. So we've got a real breadth of skill and experience here. We went out and recruited for it. And again, it's because we have an ambition over the next 10 to 15 years to have staying power, to be the aggregator, and to be a billion-dollar business. So we've really been building and designing with that end in mind. And the last thing I'll leave you with is, something you highlighted at the start. Normally, I don't spend a lot of time talking about multiples. We're not out raising money. So, frankly, the stock price will do what it's going to do. But I think for anyone that's watching and listening, it's important to note against our peer groups, we represent an enormous opportunity. If you look at our enterprise value over sales, we're 0.8 times revenue. Our peer groups are 2.5 to 4.3. Now, I think realistically, Martin, the market has stopped looking at revenue multiples and said, let's take a look at what your profit multiples or your margin multiples are. Because we haven't been profitable to this point, I think that's probably had some of the impairment that we're seeing. But if you look at one of the best indicators, our gross profit, we're trading at 1.8 times our gross profit. I mean, this is a really low multiple on our GP. Our peer groups, again, anywhere from 7 to 7.5 times. I think this is your best indication of where we're heading and where I think that's going to start to compress as we demonstrate our path to profitability. Again, when you've got such strong gross profit like we do, and that should be, heading up in the direction of 50%, that ability to drive those flow through margins to the bottom line, I think the market will start to look at us differently when they see more product revenue and more of that EBITDA and cash flow at the bottom. I think we'll start to see these multiples look more like our peer group, which means there's a great opportunity right now while we don't look like that. So that's it, really.
I find sometimes the market, they like simple comparing things. Just looking at your gross margin, it's kind of halfway between a professional services company and a SaaS company. So maybe the market just like, what bucket do we put you into? And it kind of creates confusion. And they go, well, they're a low margin SaaS company, but you're a hybrid of the two.
Well, and look, I think the examples here would show you that regardless of which bucket you put us in, all of the multiples tell you that we're under whatever peer group you decide to compare us to. Look, I think some of it is if you're in small cap land, I think some of it is when you're not profitable. Certainly, if the view is that you're going to be burning cash for a while, I think that makes people nervous. I think as we start to demonstrate the path to profitability fairly quickly, I think the sentiment will change. These things change quickly too. I don't think it'll take long for the market to recognize the transformation of the business, and I think these numbers will start to compress rather quickly. At least that's my hope.
Yeah, and also I'm just kind of guessing. I don't know what actually the comp table consists of, but I'm guessing you're on probably the smaller side of that, so you're maybe getting a bit of a small cap discount, and then as you grow, that'll probably, hopefully, that'll then get diminished as well.
Yeah, and I think the definition of small cap changed this last year as well, right? So I think we've seen, the move towards what we'll call safety tech stock, but safety tech stock's not going to grow the way we're growing. So I think there's trade-offs with everything. Knowing your risk profile, seeing where upside is. There's some great opportunities in the market right now, and I really encourage people to look in small cap land, because I think there are some great buys like our own that have significant upside as they continue to grow and deliver more profitability. I think these are going to be tech winners long term.
All right, got a question here from the audience. What is the critical mass for Canadian professional services business? Are you guys at 100 million larger player, or can you see room to grow your revenue 5 or 10 times from here?
Yeah, look, go back to our vision and mission. Like, we're not going to be the market leader at 200 million in revenue. So our long-term ambition is how we grow this to $1 billion. And when I say long-term, 5 years, 10 years, that's a combination of acquisitions and organic growth. The way we build these with business units allows us to be able to break things apart and separate them if and when necessary, to create more scalability. So I can tell you, we think each one of the current categories should comfortably be able to get to $100 million in revenue each. That's $300 million business. The 2 of the 3 of our businesses are already at a critical mass that produces significant cash for their operating unit. We reinvest those dollars in the products and some of the other things we're doing, but we've already reached a level of scale that each of our professional service business units can kick off a fair bit of cash.
Do you have, I don't know, you probably won't be willing to say it, but you've got your 3 kind of core business units. Do you have your eyes on some other ones so that 300 million opportunity could go to 400 or 500, and you mentioned the $1 billion sort of 5-10 year vision out there? Is that growing those $100 million units to bigger, or getting a portfolio of 5 or 10 business units out there?
I think it's a bit of both, Martin. We can certainly add another category. In fact, some of them we might be able to divide them. The categories we've got, if we want to create more entrepreneurial capabilities, take a $40 or $50 million business and turn it into 225s. There is a certain amount of benefit of getting to scale, right? The quality of leadership team that you can have, the way you run those business units. We have 3 great leadership teams inside each of them. There's a real cost to standing up a whole new leadership team. So there's some elements right now. I think our first goal would be to take the 100 and maybe turn it into 150 before we have to break it up. I'd love to be running no smaller than $50 million business units.
Gotcha. And I think we're wrapping this up here, and I always like to end with what kind of news flow should investors be looking at over the next 3, 6, 12 months? Obviously, you're not going to put any sort of specific timing on acquisitions, but that could pop up anytime. What other kind of news flow, like big contract wins? You're going to be announcing your big bookings or billings, obviously the quarters. Okay, can you flesh that out a bit?
Look, I think consistency is what we're after. We've been producing some pretty consistent bookings. Feel very good about the state of the pipeline. So yes, you're going to continue to see, we believe, good news coming from bookings. I'm always a little cautious about predicting too far in the future with, the state of the current, the climate of the economy, those kind of things. We've so far not seen any slowdown. That doesn't mean slowdowns couldn't happen, but we're very optimistic based on the activities we're seeing with our customers. So you continue to see good customer wins. You're going to continue to see strong bookings. You will start to see more product-based news from us. Part of the changes we're making are cutting the number of things we're doing and investing more in the ones that look like they're really accelerating. I think you'll start to see more news around 2 or 3 of our bigger products. And I have, again, I have no doubt within the next 12 months, you'll have at least one acquisition to talk about with us. But as you said, I don't know whether it'll be, next month or this time next year. There's 2 parties that have to agree, and sometimes that can take a little while.
You mentioned the uncertain economy. I'm curious from your perspective of your customers who like just what their spending activity looks like as well. They're running commerce platforms, so they've got sort of a day-to-day view of how much businesses and retail and consumers are spending. Do you have any perspective on what the economy's looking at out there? What the state of your clients are like? Are they nervous or are they getting a little cautious? Any perspectives you could bring on a sort of macro level?
Yeah, look, I think it was a little bit like what we saw in the pandemic. During the pandemic, our professional services business got cut in half in 30 days because people were nervous and they wanted to protect cash because they didn't know what to expect. We expected it was going to come back, and it did. It took a few quarters. We haven't seen that kind of dramatic cut this time, right? Whatever uncertainty folks are feeling, there hasn't been this, okay, stop everything you're doing. I think you're seeing more discipline. I don't think people are willing to accept half-page business recommendations anymore. We are finding contracts are going through more hands. Business cases are required. Maybe it used to be, a technical or business person before could sign off. Now the CFO and maybe even the CEO want to get their eyes on the business case. So we're seeing a higher level of scrutiny, looking for returns on the dollars they're spending. But I don't think that's a bad thing for us, because generally the stuff they're doing with the work they do with us leads to great business outcomes. So this is essential because it either drives revenue or lowers cost. Those will continue to get spending. I think the one thing that's changed, Martin, is people aren't willing to wait 3 years to get an ROI. They want to see smaller chunks earlier, a lighter touch to getting some results before they continue to reinvest. So I think that's part of what we're seeing. It's not less spend now. It's just not committing to 5 years of it until they see results.
Gotcha. All right. Well, Bill, on that, let's wrap things up here. Thank you very much for taking the time to talk about Pivotree. That was really great. Thank you.
Martin, thanks for having me.
Cheers.